There's something really odd happening in the bond market that you should pay attention to. Take a look at this chart right here. In the last 3 weeks, the US government has borrowed an additional almost $500 billion. Now, whether you're interested in the stock market or just an average American, you definitely want to listen up. I'm going to be breaking it down for you. And towards the end of the video, I'll tell you exactly how I'm positioned here. Now, here's a chart of the 10-year yield. This is the 10-year treasury. It is one of the benchmark treasuries. This right here is when the Fed cut. So the Fed cut rates, but the 10-year yield is still up 17%. How could that be possible? The Fed just cut interest rates, so how could rates be going up? And more importantly, why I think the US entities, which include the government, the Treasury, the Fed, etc., will be engineering a recession whether we like it or not. This is why I also told you on this channel why I'm not really looking to buy a ton of stocks here, as the Fed is trying to engineer a soft landing. There are a few opportunities which I've shared with you, which I'll go over with you briefly towards the end of the video. But in general, I'm not buying stocks here. I'm actually looking for a moment for a trigger to offload some of my short-term and mid-term holds. So let's get back to the yields. Why are the yields going up while the Fed is cutting rates? There are a number of reasons for this. One is the government's insatiable obsession with spending money. And in order to spend money, they need to borrow money. Let me explain. This is a chart of all federal government expenditures, and you can see that it has been steadily rising until we get to this point here. This right here is the pandemic, and then we started spending like crazy. Now, for some reason or another, we actually dropped off, and we are now ramping up spending back to close to what we were seeing during the pandemic. And because the government has an obsession with spending money, or an addiction rather, we have to borrow that money. See, the government only makes money one of two ways. Either taxes or by borrowing, in which case they are issuing treasuries to the public with a promise to repay them back. So when you and I buy treasuries from the government is borrowing money from us, and they're going to promise to pay us back 4% or 5% or whatever the yield is based on the term of the treasury. The treasury can issue treasuries basically whenever it wants. It has to get approval from Congress. So Congress greenlights some spending, but in order to finance that spending, they need to borrow more money, so they greenlight the borrowing. And the borrowing is in the form of issuing treasuries. So what happens when you flood a market with assets, right? If you flood the market with Ferraris, what happens? The price of Ferraris goes down. When a company floods the market with stocks, what happens? The price of stocks go down. If you flood the market with treasuries, the price of treasuries goes down. And remember that the price of treasuries and the yield are inverse, which means the yields go up and the treasury prices go down. And the yields go up in order to try to attract more investors, because investors look at treasuries and they're like, nah, that's not really that attractive. So the yields will have to keep going up in order to find new buyers. Now, another reason that yields are going up is because the markets are pricing in a Donald Trump win. How do you know that? Well, because the bond market doesn't lie. So they know that a Donald Trump victory will mean more tax cuts, because that's what happened last time he was president, and that is what's being promised. That's fine, and it's great that the average American gets a tax cut, but what that means is that the government is going to be taking in less money, which means that they're going to have to borrow more money, which means that the investors, treasury investors, are expecting yields to rise in the future because less taxes are coming in and more borrowing will be needed in order to fund government spending. Another reason that yields is going up is because data is coming in somewhat strong. If you look at the unemployment yield, it went from 4.3% down to 4.1%. So it looks like unemployment is trending down, at least for the last 3 months as of the time of this recording. So that means that the Fed doesn't have to act super fast in order to cut more rates. And if the Fed is not expected to cut more rates because strong data is coming in, then that means that there isn't a rush to enter into treasuries and take advantage of that yield. And if there are no buyers for treasuries, remember, prices go down and yields go up. And you can see that here with the expectation that the Fed cuts 25 basis points in November. And December is really interesting. There is a 32% priced in chance that the Fed actually doesn't cut in December because of that strong data. Obviously, this is going to be fluid based on more data that comes in. But as of now, the expectation of rate cuts is lower than it was before. And if you look at the amount of money that's parked in money markets are now paying an average of 4.8%. So if money markets are paying close to what treasuries are paying, why would investors lock up their money for longer? especially if they think that we might be in a more inflationary state in the future because of tax cuts and more government borrowing, right? That creates more inflation. So in that case, why would an investor tie up their money for 10 years in a 4% and change treasury when they can get 4.8% in a money market and essentially pull their money out whenever? And that is why we are seeing the most money ever in money market fund assets. Around $6.5 trillion are sitting in money market funds, the most ever, right? Because they're getting a similar yield to treasury. And this is the reason that we have investors like Stanley Druckenmiller, like Paul Tudor Jones. Both of them announced that they are short the long end of the curve, meaning long dated treasuries, 10-year and above, because they expect investors to take in everything that I'm telling you right now and not buy those long-term treasuries and not tie up their money in those long-term treasuries, which means that the yield is going to go up for long-term treasuries. That's what they're expecting. And the price of long-term treasuries is going to decline. That is why they are shorting the long-term treasuries. Remember, they're not shorting the yield, they're shorting the prices. And this is why we tend to get recessions followed by market crashes when the Fed cuts. A lot of inexperienced traders and investors look at the chart and they'll say, wow, every time the Fed cuts, we tend to get a recession and a market crash. Aren't Fed cuts supposed to be good? Well, that's the thing, is when the Fed starts cutting rates, then it starts affecting things in the bond market. And all of these elements of the financial system have to be perfect in order for us to get a soft landing. Unemployment cannot be higher than expected. Inflation cannot come back roaring, right? The government shouldn't be borrowing even more money and spending out of control, because obviously that will affect the yields. Yields can't go out of control because then the Fed will try to have to bring them down, but they can't bring them down if inflation is coming back. And if unemployment goes up, then they do have to now factor in Fed cutting once again, but they can't cut if inflation is coming back. You see what I'm talking about here? It's sort of this impossible set of circumstances to control. That is why we've never had a soft landing. Now, in terms of rates here, I'm not really panicking about rates unless the 10-year starts getting above 5. If the 10-year gets back above that psychological level of 5%, where usually that's the high end of the 10-year, at least in recent times, in recent decades, if it starts getting to 6, 7, 8, we are in unprecedented territory, things that we haven't seen in decades. But I want you to think of one thing. Remember, the Fed is paying interest on these treasuries, right? And every time they issue new treasuries at a higher yield, if yields continue to go up, they have to pay that as interest. Your yield is their interest payment. And now the government is close to having a $1 trillion interest payment annually. That is the highest ever, obviously, and the highest interest to GDP ratio we've ever had. So a $1 trillion interest payment will have to be made yearly if the Fed continues borrowing at these high rates. And if the US doesn't pay that, then they default on their debt, which is something that's never happened. So in my view, if these yields continue to get out of control, the government and the Fed, they're going to try to have to engineer a recession to bring those yields down, because they cannot continue to pay these high levels of interest. We're already at $1 trillion per year interest payment. So what does this mean for the stock market? Well, like I said, I'm only buying asymmetrical plays here, things that are too cheap to ignore. Recently, I bought Tesla. Recently, I bought CrowdStrike. As you can see here, I bought NVIDIA when it went under $100. I started a position in ASML. So there are a few things here that I think are asymmetrical plays, but I'm not pouring money into index funds here at all-time highs while the Fed is trying to engineer a soft landing. As a matter of fact, like I said, once I start seeing the 10-year and 3-month uninvert, then I will start thinking of selling. And by the way, this is what tends to happen. As I was saying, that the 10-year yield is rallying, right? This is part of what happens once the Fed starts cutting and they cannot manage the yield and inflation and unemployment scenario. So the 10-year yield is rising, and now the 10-year 3-month yield is the most uninverted since we inverted back in August of 2022. So once this uninverts, that means most likely that the 10-year has gotten out of control. And in my view, that is when it's probably time to offload some of my short-term and mid-term stocks. Now, me personally, I'm not going to be shorting bonds. I don't believe in that just yet. But I have positioned myself in some commodities at major support levels. So I recently bought call spreads on crude oil futures. I posted my trade on X. By the way, follow me on X for free daily trading and finance content. But I closed these for 133%. I'm still looking to long certain commodities on pullbacks, mainly oil and gold. I recently sold cash secured puts on Tesla because I thought it was too cheap to ignore. Also, I thought that it might give some more detail about Robotaxi during its earnings event. Earnings are actually right now as of the time of this recording, and Tesla is up. Holy crap. This is in live time, guys. Tesla is up $25. Oh my God, Tesla's up $25. So beat the expected move. As a matter of fact, on X, I said today, here's what I wrote on X before earnings, by the way. You could check the timestamp right there. But I said Tesla's coiling like crazy. Earnings are tonight. Here are some stats for you guys. Tesla beats the expected move 75% of the time. So what I ended up doing, aside from the put that I sold on Tesla, I also bought a strangle. This is when you buy a call and a put, betting that Tesla will beat the expected move in either direction. So far in after hours, it looks like that is going to heavily pay off. Another thing that I'm interested in here is Bitcoin miners, Bitcoin in general as well, but Bitcoin miners on Bitcoin pullbacks. I think that once Bitcoin breaks out of this long-term trend here, this yearly trend, once it breaks out of here, it will start to create new highs, especially in this environment where we have investors that are terrified of rising yields and returning inflation. This is why gold continues to make high after high. By the way, this is the first time in history, I believe, that both gold and the S&P 500 are up by 20% in the same year. But commodities are really sensitive to volatility and to inflationary scares. So on pullbacks, I believe that as long as we're in a rising yield environment, I'm going to be looking to long the pullbacks on both gold and oil. In terms of when I'm going to be buying the indices again, what I typically wait for is at least a 5% decline. I don't like to buy the S&P 500 at all-time highs. I already load up heavy when we get corrections like the one that we did in the beginning of August and like the one that we got in April. I did load heavy on the S&P 500 and the NASDAQ at those times. And if we do get a more than 5% drop, I will load up again as well. I don't typically miss an opportunity to buy discounts, but I'm not comfortable, once again, buying the S&P 500 and the NASDAQ here while the Fed is trying to engineer a soft landing. Now, big announcement, we did open up a membership tier just for investors. So if you're not a day trader or a swing trader and you're only interested in my long-term analysis and my stock analysis as well, including what stocks I'm buying and at what levels, make sure you sign up to the investing tier below. It is only $35 a month for a limited time before those prices will go up. But make sure you check that out. And if you're a trader, obviously we have the trading and investing membership, which is the higher tier. So you want to check that out as well. I trade live every single morning at market open, and I live stream it to hundreds of traders. But in summary, I don't think the Fed is going to engineer a soft landing. And to me, that is very evident by what's going on with yields here. For those of us that have been around in 2008 and 2001, this is the typical thing that we see. Yields start going haywire. That is why you have the yield curves uninvert, and then the long end of the curve goes haywire some more, because the inflationary fears come back, as well as fears that the government is going to be borrowing more money, fears that yields are going to go up further. So the treasury market, at least the long end, doesn't find a ton of investors that are willing to lock up their money, and they would rather flee to safety such as gold, or now we have Bitcoin or money market funds. And in the longer term, I truly believe there needs to be a solution for the public debt. I'm filming this before the election. I haven't heard either candidate talk about tackling the public debt, right? They only talk about programs that they're going to create, and they talk about tax cuts that they're going to institute. That's all great, but that doesn't help the public debt. It just seems like this right now at 36 trillion is a problem that they're willing to ignore and let mount and kick the can down the road, right? I don't know how this bubble right here bursts eventually. I don't know when. I don't know how. Everything I'm talking about is relatively in the short term, but it doesn't address the underlying problem that the U.S. is just obsessed and addicted to borrowing money right now. as well as spending money for no good reason. So I don't know what the answers are, and I hope that we finally do get somebody that is willing to address this, because this kicking the can down the road, we might survive it, but for sure our kids or their kids are not going to survive it. Anyway, traders, that is it for this video. That is why yields are rising even though the Fed is cutting. You have my analysis. You have some of my plays. If you want everything else, sign up. Link is in the description below. You get to chat with me all day, every day in the investing and trading floor. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.